Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Midweek Takeaway. Today we're joined by Pieter Krügel, CEO of Mast Energy Developments. Welcome back to the podcast, Pieter. How's life?
Hi, Phil. Hi, Kevin.
The company has just announced that it's signed exclusive heads of terms with C0 Markets Limited for a joint venture to develop and operate AI data center power supply solutions, targeting the rapidly growing demand projected to reach 8 gigawatts by 2030. Initial focus will be on building 50 megawatts, scaling to 150 megawatts plus, with discussions already underway for a 25 megawatt site. The UK government's commitment to AI growth and designated growth zones with streamlined planning adds strategic value. The JV positions MED as an early mover in this sector, aligning with its 300 plus megawatts flexgen strategy, with a definitive agreement to follow soon. So tell us more about this exciting head of terms with C0 Markets, please, Pieter.
Thank you for that overview, Phil. That's spot on. Well, we've identified the opportunity quite some time ago, I think globally, and that's ramping up significantly over the past few months. There's been an increasing growth in the AI data center development, especially in the US, but the UK is also very committed to catch up with that. In fact, the UK government has stepped in recently and formally announced that it wants to scale the UK's public sector AI computing capacity by at least 20 times by 2030. And the expectation is that the associated electricity demand to power those data centers will go up to 8 gigawatts by 2030. So there's a significant gap in the power supply for these data center developments, and we realized that our power supply solutions is a perfect fit for these AI data centers. So we've been developing this strategy for quite some time. We've been in discussion with C0 Markets for a while now, and we think they're a perfect fit for us. They're involved in the energy markets in both the UK and Europe for many years now. They've got deep and extensive relationships and a proven track record, and we feel that joining forces with them, we can expedite the strategy. So essentially, we want to, on the one hand, attract data center developers to co-locate next to our existing and future sites to gain benefit from economies of scale, but also similarly on the other hand to co-locate next to existing data center developments, one of which we're already in discussions with. It's a 25 megawatt AI data center development. They're looking for a power solution. We've presented our solution to them. They think it's a perfect fit, and it's a very good opportunity for co-location. So at the end of the day, it complements our strategy. It will expedite our plans to build a portfolio of 300 plus megawatts.
You know, as you're South African, your data, but we're data, okay?
I'll keep that in mind, thanks.
And I know the US would be data as well, so there you go. Anyway, that aside, you said that the UK wanted to go from, I'm not sure what the number was, to 8 gigawatts by 2030. How much in relation to how much electricity in the United Kingdom as a total is 8 gigawatts in terms of amount?
So at the moment, it's about 8% of total generation capacity. And the idea or the plan from government side at least is to keep it at that level. So the UK is the second highest user of power for AI data centers, only second to the US in relation to total generation output. So I think it's in the interest of everyone, especially the UK government and their energy reform and clean energy plans, to keep that number at 8%. And the only way that they can do that is to increase generation capacity, and that's where we come.
So these data centers have to be based in the UK because of what reason? You know, why can't they put them at much cheaper electric areas?
I think it's a part of the reason is distance to location. So you want to be close to big cities where the data is used. So that's part of the reason at least. But, you know, I think for us, we're looking at opportunities globally. Obviously, the primary focus at the moment is the UK, specifically because of the UK government's commitment to grow the sector. And we could clearly see that there is growth. It's been recently announced that the UK government is supporting the biggest supercomputer in the UK to date. So that's a very positive sign. So there's certainly demand for this.
So when you talk about the ability to use the existing sites, how do you envisage that? You're still going to be able to come in on time, the wind's not blowing and the renewables aren't coming in, but how does basically mean that these sites are going to be used sort of 24/7 as opposed to, just when they're required?
Yes. So the benefit for us is that it would result in an increased generation demand, for our assets. So on the one hand, we've got our current business model where we generate based on the UK national grid's demand. We also have the capacity market, of course, but co-locating next to these AI data centers would mean that they would also take a portion of our generation because they have to be online and processing 24/7, and they rely on national grid to supply them predominantly. But we would act as a backup, and we would have a private wire arrangement with these data centers, and they would call upon us as and when, which is typically when we don't need it elsewhere. So that's the primary focus. We are also looking at options where we are the primary supplier to these data centers, and they rely secondary on national grid. So we're also looking at that.
And which way do you prefer, and which way is financially better for Mast?
I think the latter is probably the better economic outcome for us. So if we can have a private wire arrangement with a single offtake, a single private offtake, supply them 24/7. That's the better economic outcome for us. But that does require certain specific elements of the site. We would need to have different types of technology that's able to run 24/7, including batteries and solar, and a larger footprint for the site. So I think for our existing sites, which is a smaller footprint, that's probably going to be as standby for these data centers. So certainly a benefit to us. But on existing data center developments, like the one we're discussing at the moment, the site footprint already allows for a generator to come in and provide the data center with a primary power solution.
So you would already have the land in place on the data center's land, and then you're able to develop that and obviously provide with the electricity as a primary provider then.
Yes.
That's right.
Yeah. Yes.
Okay, very good. So how do you see this accelerating Mast's attention?
So we've got the two existing strategies. So we've got the development portfolio, and we're growing that significantly. As we've recently announced and discussed on this podcast, we've increased our development portfolio almost twofold, with 25 megawatts coming into that. We're growing that as well. Our next strategy is to acquire existing sites and apply the proven strategy that we've done on PyBridge, and this is going to be a third strategy that's going to run in tandem with the other two, where just as a practical example, if we're able to do a deal with this existing 25 megawatt data center development, all of a sudden we're adding 25 megawatts of generation capacity to our portfolio. So I think we've got three strategies now. Each one of them will contribute megawatts to our portfolio in order to get us to that 300 megawatt number.
What financial implications to actually build it out on these AI data centers is there going to be?
One of the attractions for us of this strategy is that we don't need to reinvent the wheel. Our existing solutions is fit for purpose. We know what the capex requirement there is. We've got funding solutions in place for all of that. So it will just be an extension of our existing solutions.
Okay, so there'll be funding in place to do this. Obviously, you need to put some capex in. But
yes,
if it's a primary addition or primary electricity, is there an offtake agreement with those people that they actually pay some of that money up front to help you develop it or not?
Yes, absolutely. Typically, the AI data center developers, is backed by significant funding, because the capex requirement for a typical data center development is fairly significant, and they are very open, because I mean the power source is a critical element to their business model, and so they're very, very open and willing to partner with generators and to co-fund the generation assets.
Okay, very good. So as you said, we have these three ways of going now in terms of what's happening with Mast. I noted that you had another note out the last week or so. Do you want to give us any more details on that?
Yes, so ICF Research are looking into Mast. They released an initial equity research note following our equity fundraise recently, following our RNS announcement about the development projects. They updated that note, they updated their forecast and view, they updated their value range, and I think that's exactly what we're looking at the moment. There's significant value at the moment. We're moving towards the catalysts in order to unlock that value, and we're very excited about the time ahead.
Very good. Well, Pieter, as you said the last time we spoke, that there will be plenty of news. Well, we really all should be on the beach, but anyway, I suggest that you should carry on working, and then you need a holiday after this.
Yes, no, very much, moving this forward. And, just quickly, so we released a revenue update on PowerBridge last week. The numbers look strong. Revenue is up 30%. So, I think that just kind of backs the whole business model and our strategies going forward. And we can very clearly see that, we're being approached by funders, based on everything that's been happening. And that's a very positive sign. So if people are coming to you with significant capital to invest in the business model, I think that's a positive sign.
Yeah, for sure is. Yeah, we saw those PowerBridge numbers. Have you any more news on whether you're going to take up the third engine and update it?
Yes. So at the moment, we're waiting to apply for the final capacity market contract, which is going to be a full term 15-year contract, and so we've got CM contracts up until 2029 at the moment of around 1.7 million of guaranteed gross margin income. On that, we want to apply now for the final contract, which is going to be 15 years, and depending on what the pricing of that is, that could be worth up to 10 million plus, depending on the pricing. So once we've got that, we've already got offers from commercial banks on the table. That's the final requirement. We go to them, they refinance the site, and we do the third final overall, then we'll move forward.
So when you say £10 million, that's over 15 years?
Yes.
That would be on top of what you're already getting? Or that would
Yes, on top of.
Okay. Explain how this works so everybody understands.
Yeah, so typically, and using Hendlip as an example, so on our Hendlip project, we applied for and was awarded a CMT-4 15-year contract at £60,000 per megawatt. So Hendlip is a 7.5 megawatt site. So that means that's £450,000 of guaranteed gross margin income per annum. And over the 15 years of that contract, that's £6.7 million of guaranteed gross margin income, which is separate to and in addition to the merchant trading income of the site via our PPA with Statkraft. So on the Hendlip side, which is 7.5 megawatts, we're looking at circa £7 million of CM income on that. So similarly on PowerBridge, which is an 8.1 megawatt site, assuming we get the same pricing, which is £60,000 per megawatt, that's almost £500,000 per annum, multiplied by 15, that's 7.3 million of guaranteed gross margin income, plus the 1.7 million of CM contracts we already have, and that's all guaranteed.
The 1.7 million will finish in 2029, did you say?
Yes, and the final contract will start running on the 1st of October 2029 for 15 years.
Okay, so the scenario is that these things are going to be profitable. This is why cash is coming in, obviously, from the point of view. We're still looking at 30% profit margins, roughly, are we?
Yes.
Across the board. And also from the point of view of management contracts with some of these deals that you're doing, the management contracts are on top of that 30% margin or normally?
Yes, on top of, yeah.
Very good. So really it's a race to see how many megawatts you can get in production in the next sort of 6, 12, 18, 24, 36 months.
Yeah.
And for sure, if you can get 300 megawatts plus in that period of time, then you're going to be worth significantly more than you are now. That's a given, I think. So yeah, we look forward to speaking to you in the not too distant future. And yeah, if you haven't looked at that note, have a look at it and see what you think. Thanks for your time.
Excellent. Thank you, Kevin. Looking forward to the next one.
Pieter Krügel, CEO of Mast Energy Developments. Thanks very much for appearing back on the podcast.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.